You want to ask that?
Sure.
Okay, ready? You got 5 seconds of quiet. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Brian Praxis. I knew I could do that sometime.
Changing my name.
Brian Berg of Praxis Capital, and my other co-host, Mark Honfa, Pacific Private Money.
Mark Pacific.
Mark Pacific, yeah. We're in the studio also with Mike Zaidlin, who is a registered investment advisor who's giving us great advice about and information about retirement plans. And when we cut to the second commercial break, we asked the trivia question. This Dallas Cowboys defensive tackle blew it twice, both in 1993. Once in the Super Bowl against the Bills, when he had the ball knocked out of his hand just before scoring a touchdown, and the other game against Miami on Thanksgiving, when his failed attempt to recover a blocked field goal in the snow cost his team the game. Who blew it? Again, 3 blank stares.
Oh, God.
Leon Lett. You don't remember that? Remember that? Yeah. Okay.
Name's familiar.
Mark, you were going to ask the last question for Mike.
Oh yeah, Michael. So we talked a little bit about Roth and traditional IRAs. What else should we know about IRAs? What can you tell our audience?
Well, a couple things, but I definitely want to get back briefly to the benefits of a Roth IRA. Because if that's something someone's considering, one of the main benefits is there are no minimum required distributions, and so
Not yet.
Not yet, right? Exactly. And so, given that, for example, there's going to be a 3.8% tax on surcharge on investment income over the coming years, that's something that people also might want to take into account too, if they're in a certain tax bracket. In addition, leaving a Roth to, as I've said before, leaving it to a beneficiary could mean that you've got about 70 or 80 years of growth in it. So there's
That could be amazing. Well, tax-free growth.
Well, yeah, and one idea for people is to consider if they have a child who's got some compensation income, because you can't really contribute to an IRA unless there is compensation income, and they can't quite afford to, the child can't afford to have their own Roth, the parent could donate $5,000 or contribute $5,000 to that and start them off on a Roth, and over, say, 40 or 50 years, if it grows at 5 or 6%, that $5,000 is turned into $100,000. Now, I'm not guaranteeing that, but it's something that people should be aware of, that they can make that contribution.
And Mike, if people have more questions about retirement plans,
Sure.
how they can hold you?
They can reach me here in San Rafael at 415-785-4585. And sorry, Mark, I didn't get a chance to answer your question, but we can talk about that another time.
All right, we're going to get right into email time here. We received an email that, because you're a registered investment advisor, we're going to let you answer this one, Mike. Here it is from a listener asking about double E bonds, the pros and cons. First of all, what is a double E bond and what are the pros and cons?
Sure. Well, a double E bond is a United States savings bond, and they can be issued in increments of $25, $50. I think the maximum for an individual to buy would be about $5,000 a year. And they pay a stated interest rate. I think it's usually about 3%. I think for a 20 to 30 year bond now.
Which sounds like a lot of money in this day and age of a quarter percent.
But you're locking it up for how long?
Well, it's also it's a lot of safety, that's for sure.
Until inflation runs at 4.5%
Yeah.
or 5.5%.
Then you're guaranteed to lose, yeah.
Exactly, and but there are a few little twists and turns with savings bonds. One is I believe you have to hold it for 5 years, otherwise you forfeit 3 months of interest. But one of the reasons people do buy them is for their child's education, because the interest on it is tax-free if it goes to higher education for your child, assuming that you're not in a certain high income bracket, which I don't off the top of my head know what that is. So if that was the case, and you think you would be in that bracket, you could always buy it and put it in the child's name, assuming the child's not going to be in a high bracket when they're ready for college. They would not be taxed, or would be taxed at very low rates. So,
And some of these bonds, when they come due, if you don't cash them in, don't they stop paying interest?
well, I think these pay interest for up to 30 years. I
So
think
I
it's
mean, after
20.
30, then you
Yeah.
better remember to
I mean,
have it in your safe deposit box.
Like
Right.
any form of quote ultra-safe government, U.S. government bond, it probably government bonds do belong in fairly conservative portfolios. Whether this is a better way to invest than, say, a 529 plan, where you could grow income quicker if the stock market actually went up, and then you also wouldn't be subject to income limitations. Maybe a 529 plan is something that people who are buying EE bonds for their child's education should consider.
Okay, we're gonna move right on over to Mark here. Mark, we received an email from a potential borrower this time instead of a potential investment. Here's the question: can I use my own appraiser, or do you have one that you use?
Oh, interesting. Anyone who's done a traditional bank loan in the last year or so knows that the whole appraisal process has changed dramatically. In fact,
a nightmare.
It is a nightmare. And again, one of the benefits of going to a private money loan, like we offer at Pacific Private Money, is that we're not bound by the same rules and regulations that the banks are that the banks operate under. And primarily, it's because we are making investor loans. We're not making consumer home loans. The consumer home loan industry has really been, it's just been regulated like crazy, and that's a whole different topic. But the answer to the question is that oftentimes we'll get a loan request and the borrower already has an appraisal, and we can absolutely accept your appraisal. In fact, oftentimes we'll give the name of someone and say, or several names, and say, choose one of these guys or the appraisal, or they'll bring an appraisal to us. We'll always review it, and there still are issues about appraisals in the market today, especially in the declining market.
Like you can't say, I've got this year-old appraisal.
Yeah, right.
Yeah, sure.
I mean, even if it's 6 months old, the market, it's the end of 2011, and looking back, the fourth quarter, man, the prices just, in some markets, just really went down, considerably in some areas of the Bay Area. In fact, not too long ago, a real estate agent, a licensed real estate agent, brought me an appraisal on property that she had bought and fixed up with the intent to sell, and the appraisal was for, I want to say it was for about $350,000, and she wanted to know if she can get cash out financing at 65%, which is usually the maximum cash out financing we offer. In fact, it's the most that, most private lenders today, that's the upper limit to what you can pull cash out on a property you own. It's not 65%. Anyway, she brought this $350,000 appraisal, and so first thing we do is we pull up the MLS just to see if it had been on the market recently, and it was removed from the market 30 days prior when it wouldn't sell for $249,000. But I got an appraisal. So it's
MAI,
it
made as
depends.
instructed.
Right, exactly. So even though the industry's cleaned up quite a bit, if it's an old appraisal, or if it's an appraiser that maybe is not familiar with that particular neighborhood, then of course we're going to look at it pretty closely. But the answer is we have a lot of flexibility in private lending. Yes, you can bring your own appraisal, your own termite report. You can basically give us all the documentation that we would normally look for and require in underwriting a private money loan. Basically at the end of the day, we're real estate investors ourselves. We know the market here in the Bay Area. We've been here. I've been a Bay Area resident for 50 years and in real estate for 30 years. So there's not a lot of tricks that someone's going to pull over on our little.
Well, it's good that you have a lot of good due diligence.
Yeah.
Your investors, I'm sure, appreciate that quite a bit.
Plus, you can use your judgment on the appraisal too, and make sure, because I had a house recently listed for $419,000. We got 4 full price offers, and the appraisal came in at $410. And isn't the definition of market value where you have willing buyers and a willing seller?
Exactly.
And so it's great that you can say, okay, I can use judgment. We can go get a different appraisal, because banks don't always exercise that kind of judgment.
Okay, here is an email. We'll go right into with Brian here. Here's an email we received for you. Dear Brian.
Didn't really start that way. You're making that up.
No, that part I'm making up. Okay. I'm thinking of investing in a couple of rental houses, but I'm concerned about vacancy rates. Where are vacancy rates now, and are they going up or going down?
Well, that is an interesting question, especially as it relates to this person talking about buying rental houses. And it's really common for me to get questions about vacancy rates because people will see vacancy rates quoted either in news articles or in research documents, and typically what those vacancy rates are referring to is multifamily vacancy rates, because that data is easily obtainable. There's services out there that call apartment complexes and ask them what their vacancy rate is, and they publish these vacancy rates. And there's a big disconnect, especially in Northern California, between single-family vacancy rates and multifamily vacancy rates. I think we mentioned on last week's show about how only 1 out of 5 foreclosed former single-family homeowners is moving from their foreclosed home into an apartment. Most of them are moving into other single-family houses, and that's where the demand is being created. So if you're looking at vacancy rates that you see published and it's referring to multifamily, but you're interested in buying single-family, you might get discouraged from making that investment because you're seeing that data. So if you want to find information about single-family vacancy rates, there's really only one way to do it, and that's to get out with shoe leather and start calling property managers that manage single-family houses rather than multifamily apartments. And we're in the business of purchasing and holding rental houses. We have an inventory of them ourselves. So I can tell you that our vacancy rate currently is 0, and we have property managers in each of our areas that manage property for us, and in some cases they manage hundreds, and one of our property managers even manages over 1,000 houses, and their vacancy rate is currently sitting at 2.5%. Where do I see it moving? I don't see it moving much. 2.5% is pretty low. It's hard to get any lower than that, but the demand for single-family rentals in Northern California is pretty extreme, and I don't see the vacancy rates rising.
Just go on to Craigslist, there are half the number of rentals available
Yeah.
that you would have seen a year ago.
And those that are on there go quick.
Yeah.
All right, before we cut to the third and final trivia question, here is our special trivia question. There were 6 Rocky movies. We see Rocky win some, and we see him lose some in the ring. What was Rocky's record by the end of Rocky 6? Now, you have to name each opponent and whether Rocky won or lost. Here are the rules. You need to email edward@bestofinvesting.com the answer by midnight tonight and include your name, address, and phone number. Only people who have not won a prize on the Best of Investing are eligible, and I will randomly pick from among the correct emails and announce the winner on next week's show. Now we're going to cut to the third and final trivia question. Here's the commercial break, and here it is. In a 2006 wild card game, this Dallas Cowboys holder bobbled the snap on a potential game-winning field goal. Who blew it? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In a 2006 wild card game, this Dallas Cowboys holder bobbled the snap on a potential game-winning field goal. Who blew it? Call 888-912-1190. Make sure to include your name, address, spell out your email address and phone number, and we will be right back.